Welcome to Blockchain Week Day 4. My name is Amy Rose, and we are about to take a deep dive into derivatives with our host and our moderator, Paul Derham from Holley, Nethercote, Karti Mahendran from Deloitte, Caroline Bowler from BTC Markets, Toby Chapple from Zerocap, and Lisa Hornery from FX. Take the stage, please.
Hi everyone, good to see you, and thanks for watching this panel where we talk about derivatives. And so the result of watching for the next 45 minutes will be, our goal is for you to have a really wide perspective on what's going on now and where we think things are going when it comes to derivatives. So we'll do some introductions first, and then we'll talk about what we're seeing now. So I'm Paul, I'm a lawyer, and our firm is a regulatory firm in Melbourne and Sydney. We act for a lot of, in fact, the reason why I'm talking about derivatives is my background is derivatives. We act for a lot of the world's large OTC retail derivatives brokers, so far as they're connected to Australia. And as a result of that, ended up doing a lot of that derivatives work in the crypto space. And now we act for some of the world's largest crypto exchanges and groups who are wanting to offer different types of derivatives in Australia. And it's a really interesting space. So that's enough about me. If I just work clockwise around the screens as I see them, Carolyn, would you like to introduce yourself?
Lovely. Thanks, Paul. Hi, everybody. Caroline Bowler, CEO at BTC Markets, Melbourne-based crypto exchange. We've been around since 2013. We have Aussie-only clients, so if you're trading on our exchange, you're trading with other Aussies. We've done about 21 billion Aussie dollars since our inception. So really excited to talk about derivatives today. I think it's the next wave in the crypto evolution.
Thank you. Karti.
Hey guys, Karti Mahendran. I'm a principal with Deloitte Consulting. I look after our technology data innovation for the investment and wealth sector. We work with clients from an institutional perspective, super funds, asset managers, and looking to connect them with the likes of BTC Markets and other providers in the industry to say, how can they get exposure to the digital assets? How can leverage digital assets into the portfolios? What are the regulatory hurdles that they need to go through and make those connections? So I look forward to the conversation.
Thanks, Karti. Lisa.
Hi, everyone. Thank you very much for joining us. I'm a Chief Compliance Officer at FX Global and Macari Exchanges. They've both got Tier 1 market licenses, and Macari is also a provider of financial services to wholesale customers, and we offer financial, environmental, agricultural derivatives, and soon to be, just putting it out there, virtual assets, if the Treasury consult paper is anything to go by.
Excellent. Thanks, Lisa. Yeah. Toby.
Hi, my name's Toby Chapple. I'm head of trading at Zerocap. We're a full service crypto provider, and we're very, very active in the derivatives market. We use them to bring across traditional banking products into structured products into the crypto space. So we're using the derivatives market to get better risk return trade-offs and better entry and exits in the market. So look forward to the panel discussion.
Thanks, Toby. So look, I guess if we were all here to change a light bulb, Karti, you could do a strategy for us. You could connect us to the right light bulb suppliers so we could do it efficiently and profitably. Toby, you're the trader. You could help us identify and value the individual bulbs and swap them out using the best available technology. As a lawyer, I could advise you on the legal environment, including the disclosure and conduct obligations and constraints for changing the light bulb in this jurisdiction. Lisa, you're the compliance manager. You could develop a compliance framework in light of the legal environment, make sure everyone complies with it. And Carolyn, as a CEO, you could tell us all what to do. Okay, so that's the diversity of perspectives that we have today. We're all coming from different places, and hopefully you can get a really wide view. So let's start just with the definition of a derivative. Got the Corporations Act sitting here in front of me. It's pretty similar to international definitions. There's pretty much three parts to the definition. The first one is that there's an arrangement. And so that traditionally would have been a piece of paper, maybe an ISDA agreement, but now it could be just participating in a DeFi protocol. It could be a lot of different things. So that's the first leg. The second is there needs to be an obligation on one person, one party, to pay someone else at a future time. And that might be minutes or it might be weeks in the future. And the third leg is that it needs to be an amount, the amount paid needs to be an amount derived from an underlying reference rate, pair, asset, etc. And so they're the three elements. So we have a really diverse range of things that we're talking about today. Throughout Blockchain Week, you would have heard about the digitization of all different types of things like shares and other things. And so if you think about the traditional types of derivatives, some of you will be familiar with in the crypto space, contracts for difference providers in Australia and globally have been offering cryptos for quite a few years. It's over the counter, it's off chain. You've also got traditional options types products like vanillas and structured options. And so they're off chain, they're over the counter, but they're involved with the underlyings being derivatives. You've got the big institutional ISDA agreements, which are what the large players use to sort of net and trade with each other, off-chain, OTC, and then you've got on-chain DeFi products that are technically derivatives. You've got perpetual pools, you've got all these very interesting types of products coming out now. And then you've also got partially on-chain, non-DeFi order books matching leveraged derivative pairs. So they're kind of futures products. And so lots of different things. That's what we're seeing as a law firm. But Toby, do you want to tell us, what are you seeing at the moment?
Well, the derivatives market has grown exponentially just in the last year alone. I mean, in June last year, the derivatives market exceeded the spot market in notional volume terms for the first time, which is a natural progression of a financial market. The equity markets in the US, for example, trade about 14 times derivatives notional to the spot. So what it means, though, is that we can now attack the crypto space with the same level of professional management that a traditional investment bank would use the products for. So for us at Zerocap, the growth of the derivatives market in the futures and options means that we can now package up structured products in a way, and that structured products are just putting together one or two different instruments that give a much better risk-adjusted return basis for accessing this risk premium in the crypto market. It also allows for hedging of positions. We can put on collars. We can put on all the most sophisticated sort of management techniques for our clients so that they can manage risk better. And that, at the end of the day, is what derivatives are for. It's to manage risk. And so, yeah, it's a pretty exciting time for us, especially at Zerocap, because we're an AFSL license. We have a derivatives license. So, we can offer protection to an asset class that is pretty much the most volatile the world has ever seen. So there is no other asset class that needs this type of protection strategies to harness its potential.
Excellent. Thanks for that. And so derivatives really are used as a form of insurance, aren't they? And what you're doing is, it is mainly, Toby, are you mainly dealing with the institutional clients in your trades?
Yeah, we mainly deal with high net worth family office and institutions, but they're either looking to use these instruments of protection or they're using it to take advantage of the market. As you said, options, one of the main pricing in the options is the volatility. Now, if you go and can work out a strategy where you're selling this volatility, you can generate significant yields compared to the traditional space. Not by magic, just because there's 7 to 8 times more volatility in the market. So we can go and sell some optionality and generate 25, 30% a year in yields, which opens up the door to structuring different types of return profiles from that yield.
Yeah. Okay. Thanks for that. Let's just keep moving. And so we're trying to paint the widest picture we can of what's happening right now. Lisa, how about you? What are you seeing in this space, the derivative space, from the registered exchange, the licensed exchange perspective?
Yeah, thanks, Paul. Well, it's funny, right? Because I think previously there's been a lot of uncertainty in the way that these kind of products have been regulated. So companies like Toby and his clients have probably maybe been a bit hesitant in the past, and also to what Karti was talking to, they've been a bit hesitant in the past to engage fully into this virtual asset or the digital asset space, because there's been no real certainty around how the assets have been defined or what you can and can't do. And I think Australia has got a very well-regarded licensing regime. I know in Asia, the AFSL, our AFSL licensing regime is very highly regarded. And so the way that things are moving at the moment in Australia is that we're being proactive in trying to expand and use those existing licenses, especially when it comes to derivatives, so that more clients of Karti's and Toby's can take advantage of the space. And I think the ambiguity in regulation is actually starting to be addressed. And as I alluded to in my introduction, the consultation paper that came out from Treasury this week really just does lend to the fact that we're really trying to make moves in the space. And so at the moment, I think we're seeing a lot more positivity in how the regulations are being framed and what that can do to lend to the market going forward.
Excellent. Thanks, Lisa. And Karti, how about you?
I was going to say, first of all, +1 to Lisa for that background as well. Very, very topical. But look, I was going to say, you mentioned a key thing where, derivatives being used as an insurance, but I think in the way in which we see the instos turn to the derivative space is now it's beyond just an insurance product. It's as a genuine asset class, and they want to go into it. So 6 months ago, would we have had this conversation? Perhaps not, and it would have been a very different conversation around this. Initially, if you talk to a lot of the big super funds or asset managers, they're thinking if you have to go into the crypto space, do you have to actually go and physically buy a crypto token, and do you have to physically hold it? Do you have to go through an ETF or something, or do you have to go through a middle product? But to what Toby's saying, if there is that structure provided around it to say if there's puttables or callables that are applied on this and create a genuine structured product around it, that makes it far more appealing for these instos to go into, because it is a risk measure, right? So I think that's what they're looking for, is the regulatory tick to say that, yes, this is allowed, this is legal, they can go into it. If you look at a lot of super funds, they run with members' best interest front and foremost. It's about members' best interest, and it's making sure that they are doing the right thing about other people's money. So how can those be satisfied? So once they get that tick of approval, then it's about going to say, okay, let's look at the risk and let's look at the volatility, and let's see how we can bring this as a genuine asset class into our portfolio mix. If you talk to everyone, they say the magic or 1% exposure is the key, and that's what they talk about. But is it 1%? Is it 0.5%? Is it 5%? What does it look like? How much do they need to get exposure into a structured product in this room, and how does it sort of offset their existing footprints around things like ESG, for example? How is that affected? One of the questions that we got asked about from a super fund is, how do they know that the holding of a crypto wasn't mined in a sanctioned country or something like this, right? So how do they get around some of these barriers? How do they have that assurance? So these are the questions that are starting to come up, but I think we're getting the answers now, and we're progressively going to get the answers moving forward. And, one of the keys that we do look at it is how the government going to back it. And to Lisa's point, the Treasury paper is one answer, but the local CBDCs and things like that, stable coins are a queue as well.
Yeah. And Karti, the amount of consultation that you're doing to all of these different providers right now about the derivatives side of the crypto world, how is it different from, say, 12 months ago?
You wouldn't have had this conversation 12 months ago. It just wouldn't have been as a class it was considered. There would have been asking the questions around, what's happening in this space, but they wouldn't have touched it. They would have gone, who are the local providers from a value chain perspective, who's domiciled in country that's doing this, who are the people that, that they look at the entire value chain and go, okay, where is the custody of it? That would have been the first question. They would have gone, who's actually doing the safekeeping of it? How are they actually doing the safekeeping of it? It's very different to holding cash in custody versus a digital asset in custody. So these questions would have just been parked at the early stages, and we wouldn't have had any further conversation as soon as somebody mentioned derivatives or a derivative that helped a crypto asset underneath.
Yeah.
Whereas now I think people are starting to open up. There are some very large institutions tapping into this. So it is progressing at a very rapid pace.
Yeah, absolutely. Thank you for that. Now, Carolyn, running a very large, really a spot exchange, but at the same time, I know you're, I think I heard you on the stage mention that you're traveling to Dubai soon for another conference. Is that right?
I think there isn't a conference in the land that I'm not on at this stage.
So you're seeing an amazingly broad perspective of trends and what the exchanges are looking at doing, what some are already doing. What are you seeing right now?
So what I can tell you is, so my background's investment banking. The people that we've hired from coming in invariably have got a financial services investment banking background. The conversation around derivatives and prime brokerage is a conversation we've been having since I've arrived into this business, because I think that we knew early on the level of maturity that we were going to face within crypto and the importance of derivatives, properly executed derivatives for hedging in particular, were so key. What we can see is, alongside the institutional demand right now, currently the market is heavily retail. I think that's something that we need to consider. We're talking about with the regulation, which is true, but we also need to use the education of clients around, in particular in retail, around the use of derivatives. I worked on the trading floor through the GFC. I saw what, far more exotic, I suppose, derivatives could do, even to professional traders. So I think that's something that we really need to flag with retail. I have a strong degree of caution around that, around the why a portfolio would need derivatives. But we see that there's an appetite there. And I think that the accessibility in the way that the retail investors view crypto, there is a strong sense of ownership over this asset class rather than an inherited asset class as it would have been perhaps with securities. And so they are emotionally invested, mentally invested, as well as financially invested in these products. And I think that there is an appetite then to go with derivatives. For us, though, we are actively looking at it in this space about developing our own strategy around it and how we're going to approach it. We have been given in-draft approval of our own AFSL, so this is something that we'll be looking to do within the existing regulatory regime here in Australia, similar to others in this space. But it's with, I probably think, a degree of caution based on experience around derivatives. And I certainly would not want it to be viewed as though we are taking anything other than that approach with this subject, simply because of, as I say, shaped by the experiences that we've had. The upside is terrific, but these products can also blow up your book and take you down with it. And I think that needs to be something that we within the industry educate and speak to people about, the proper use of these products and why it is that you're actually using them. So yeah, so those are our views on it.
Yeah, and I think that's a good point. And definitely you're right. In Australia, you can argue that, spot exchanges nearly all of them don't have an Australian financial services license for that aspect in the crypto space, to the extent that crypto is not a financial product, which is most of the majors. But then once you start offering derivatives, it's pretty uncontroversial. You would need the ability to probably advise, deal, and make a market in derivatives to do that. And it's interesting, we've got lots of lessons that we can learn from history, don't we? So the GFC, really what led to that was people not understanding the risk sitting on some of these collateralized products. Even the investment houses were rating products as investment grade when actually they weren't. And people weren't understanding the underlying. And for anyone watching this, if I said to you, tell me now in a few sentences how the yield is generated on that staked crypto that you've just gone and staked, tell me, how is it calculated? Don't reckon many people would be able to answer that question. And that's on a basic earn protocol, right? And these derivative products, Caroline, you going to say something?
Yeah, because it was just with that. I mean, that's part of in support of that. The biggest issue that we're grappling with is not the trading piece. It's not matching trades or even the structure around what the product is. Our biggest piece that we're grappling with is around margin, and is with around those the actual intricacies of derivatives and the complexity that comes with them as opposed to just trading spot. So we take it incredibly seriously for those exact reasons, the lack of understanding around what it is that you're actually getting into. And then for us as an exchange, how do we, what safeguards do we put in place? And there is obviously a degree of caveat emptor. If you're going in, you need to know what you're getting into. But I also think we don't need to be a free hand on it either. I do think that there is a degree of responsibility to all of us in financial services to put a degree of education as much as possible around these products.
Sure, but that's from a retail perspective, right?
Yeah.
And for sure, I don't want mum and dads trading these things, but professional investors, they're fantastic for managing risk, right?
I agree with you. I don't disagree with that. My point was purely around retail, because right now in crypto, there is a huge degree of retail appetite for derivatives, which is, sometimes it gets swept up. I mean, I'm listening to a podcast earlier today, well-known Australian podcast, two young men talking about their experiences in crypto and the products and stuff that they're going into. They have no idea what they're getting into. And I think it's really on us, the subject matter to have those sober discussions. But I would agree with you, Toby. Professional institutional investors know what they're doing, or so we thought. And then we had the GFC, and then we found out we didn't know quite as much as we thought we did.
These are futures and options. They're not derivatives on derivatives on derivatives, which was the problem, I think, that we had in 2008. But just talking about the retail, there's still about 80% retail users in the world of these derivative instruments, and it creates an opportunity for us as well, right? Because the retail demand pushes the implied volatility way above realized. So, but what that really is saying is that the retailers are just using this to punt directionality. And what they're doing is they're paying way over what the Black-Scholes model says should be for the price of these options. So, in some ways for us, we're accessing this risk premium in the market that people are not pricing correctly. And that's led to enormous opportunity from my desk from that retail side. Now all the hedge funds and all the high frequency traders are all coming in now, right? But I think that sort of level of mispricing and what is occurring in the market will dissipate over the next 6 months or a year. But there is enormous opportunity now for professional investors to take advantage of that mispricing that's occurring in the derivatives market.
Sorry, just to interject here, I'm going to bring it down because that's what compliance officers do traditionally. But don't forget that if we're talking derivatives, people are, and I understand that the retail customer is different to a professional investor, but and a wholesale client. But from a regulatory perspective, derivatives have been in the Corporations Act. If you want to hold up your big weight again, Paul. Derivatives have been in the Corporations Act since whenever, especially in 2001. There has been licensing regimes, AFSL holders you have to be licensed to do a derivative. Market operators must have a derivative. You must be able to trade derivatives on your exchange in your license. Otherwise, you can't do it. People are familiar from the regulatory perspective. People are familiar with derivatives and the concept of them as products. And that does hold some sort of protection for consumers that are going into this. But again, it's introducing derivatives to retail customers, that have never even looked at derivatives ever. So yes, crypto is introducing products to people that not normally would be interested in them, I guess.
Yeah. Any comment from you, Karti, before we
move
on?
I was going to say it's an interesting play-off between retail and instos, right? Because if we look at the moms and dads that are trying to access this, and again, there'd be questions around, what is a digital currency and all these other things that lead up to it before they go into an actual product. But I would say, look, financial literacy just across the board is something that needs to happen, because there's a number of people that, from a retail perspective, that ask very simple questions. Gone are the days where people pick up a newspaper and goes, oh, okay, these are what I should be going with. That's out the door. This is about, if you're reading in a newspaper, things have moved on about tenfold from when that was printed. So if we flip it to a super is another angle of a retail spin-off and what's happening with the pool funds coming out of the retail side, right? So some people, when they go to a super, they spin off SMSFs. If they have SMSFs, then what do they go into from that SMSF perspective, and how do they get that exposure? I can tell you that we've met with some family office and clients that have had trusts and pooled SMSFs, but they don't understand what they're going into. And they don't understand what they're going into, and you ask the question saying, why on earth are you doing an SMSF in the first place? But that these are the things that are actually happening on the ground. From a super fund perspective, from an institutional perspective, yes, if you choose a strategy that they have and you go into that high growth or high volatility sort of strategy, then yes, they will do that on their behalf. But a lot of people are now starting to finally dice what they go into from a super allocation perspective. So how does that translate back into the portfolio manager side on the insto front? And then how do they then take those asset pools and look for a manager? So I think the super's one end of it, but I agree with Toby from a asset management perspective, investment management perspective, those that go through and get the futures, the options, trade those, they fully get the game, and they're just looking for a tick of approval to say, yep, we're in the clear, we're able to do this. But supers, I think, are still some ways behind and still a bit on the hesitancy side, and that's who we're trying to do the education. Because if you have a look at it now, it's contributions 10%, it's set to go to 12.5%. It's tipped to be a $10 trillion industry here, just in Australia. So there's more questions.
Yeah, good point, Karti. Thanks for pointing out that sector. It is, it's huge. Okay, so now we're going to start looking ahead. Where do we see things going from our own different perspectives? And before we do, simple, brief history lesson. One of the first recorded derivatives came from the King of Babylon in like 1600 BC, where it was law for farmers. There was a put option, basically, that if they had pestilence and floods, they didn't have to make repayments on their mortgage. And so scholars reckon that was one of the first documented derivative products out there. It was over the counter. Things have come a long way since then. Obviously, now we've just been talking about where things are at now, but let's look ahead. Where do we think things are going? I think we're at the top of the mass adoption curve. I don't think this is about early adoption anymore. I mean, we'll talk, Toby, later about this ANZ announcement today, which, the second of the 4 banks to do a big play in the crypto space. But looking forward, looking into your crystal ball, where do we see derivatives, crypto derivatives in connection with crypto? Where do we see that going in the next couple of years? Toby, do you want to comment first?
Well, it's just going to go like a traditional financial market goes. It's going to move from 2 times that of the spot market right now to around 14 to 18 times that, right? Because your ability, as more and more institutions enter the space, they use derivatives to manage their positioning, and delta hedging their positions. Basically, for the futures market is at the basis of all banking techniques. So there is just going to be continued phenomenal growth in them. I think obviously the major exchanges now are unregulated, Derham, etc. CME has listed derivatives on crypto products right now, and they're growing exponentially. We've got ETFs launched in the US on the back of the derivatives instruments at the CME. So, it's all just going to grow. And it's the real growth will come not from the retail side that are just using it to punt directionality. It's going to come as more and more institutions and hedge funds come in and access the crypto space that they haven't got yet. So, it's traditional adoption coming into the crypto space is naturally going to drive the derivatives market.
Excellent. Thanks, Toby. And I know post-GFC, there was some global reforms. One was standardising certain derivatives to make them centrally cleared. Do you think that's going to happen more, Toby? Well,
there's this, thing about the crypto world is that, they don't like, these government regulating them, right? It's part of their sort of the mantra of the space. So I think there will be regulated exchanges that are government regulated, and there will be certain market participants that can only trade on those exchanges. There's also going to be unregulated exchanges where the rest of the world can trade on them as well. So there's probably going to be a split of exchanges and what you are allowed to and not allowed to trade on.
Yep, thank you. Lisa, where are things going?
Well, thanks for asking, Paul. I'll tell you where they're going. There's going to be more certainty, I think, in the regulations. And as a compliance officer of an exchange that has the ability to be able to list these kind of products, I think that I'd definitely be looking for more certainty. But I think the industry itself is leaning towards that, and it's coming not only from domestically, but it's also coming globally. You had the Biden's executive order come out the other week. You had the Senate hearings with everyone talking to the CFTC as to why they should be the ones that should regulate regulate in America. But I think the changes at the moment are really positive for the market, and I think the words that we've heard from all sorts of people over the course of this week, including Senators Bragg and Hume, have actually given us more certainty than ever that we'll be able to have this licensing framework that'll actually really become a real pillar in the virtual asset space, and it will just mean that Australia providing financial services, people will come here for the regulatory certainty of that. If we have if we can say that we've got market licensing and we've got financial services licensing can provide the protections that are required, then that actually means that we can provide liquidity. And as Toby was saying, I mean, the space is just going to grow. I had 10-fold down here, but I like Toby's 18, 20-fold. That sounds a little bit better. And yeah, I just think it's going to allow Australia to become a global leader. If we keep going the way we're going with this and the support from industry and government working together, I think it's going to be a really positive future.
Thank you. And that's coming from you and the businesses that you're connected with there, Lisa, not only have an Australian financial services license right now, but also an Australian markets license. And there's not many of them in Australia. And so for you to say that, I think is really good insight from the most highly regulated part of the sector,
absolutely.
Yeah,
absolutely. I think the only way, to quote Yaz, the only way is up. That's what I would say. Yeah.
Okay.
I'm showing my age.
Thank you. Karti, where are things going from your perspective?
Look, I think where things are going, I agree with Toby that it is genuinely like a financial product that is going up, but there are things that we need to look at from a what's needed for that to happen perspective, and I think this is where Lisa's comments come in from a regulation perspective. So we really need the regulatory approvals before this can happen and take off. But once that happens, I think there are a few things that are hedging on things like your central bank digital coins, for example. So, the notion of a government entity going and issuing debt, for example, how does that change going forward? So it's those steps need to happen. And once it happens, I think you're not going to see a difference between how a digital asset's treated versus any other unlisted assets, for example. It's going to be the same. If not, I think in the future, you will see the digital assets actually be more regulated and have more sort of transparency than some of the existing unlisted assets that reputable managers are going into today.
Yeah, good points. Thank you. Caroline, how about you? What does your crystal ball say?
Crystal ball for this market says consolidation. I think that's what we're going to see, in particular in my sector. I think we're going to see consolidation. I think that I would echo the points that everybody else has made. I agree with Toby. We're going to see the professionalization of financial services in crypto. That's a given. I think I would also agree with Lisa's comments about compliance and regulation. 100%. That was the key risk factor we identified 2 years ago when it came in the door. The lack of regulation was a single biggest inhibitor for lots of reasons. But yeah, it's for me, I see consolidation. I think that as we push through into this to mirror traditional finance for other exchanges and brokers that currently exist in the crypto world, we're all collectively going to have to pull up our socks. And I think we'll see some M&A as a result of that. I think that responding to the standards that are required to operate a derivatives exchange differs hugely from those of a spot, and not everybody will be able to rise up to that. But it's great. I mean, I think it's about time too that we had that level of sobriety, if you like, in cryptocurrency. I think that the narrative that has dominated for so long has been the hype.
Yeah.
And that I don't think is truly reflective of how a lot of people are investing in crypto. But it makes really catchy headlines, no more than the conversations that endlessly go on about scams, even though they are a tiny minority of what happens in crypto. But it's the narrative that sells the papers. And I think it's quite looking forward to being quite sober and quite boring in some respects in crypto, just like, not to cast disparaging comments, but rather like in traditional finance.
Yeah. Yep.
Well, maybe one other thing for people to take note as well is people have to understand that the digital assets offer a far more liquid pool of assets than what some of the other asset classes offer as well. So I think that's what's going to accelerate some of the growth here.
Yeah. Good point. And look, from a lawyer's perspective, I think the law is more often reactionary than proactive. And whilst there is a proposal from Treasury that came out on Monday to regulate the markets, I suspect that if there is some sort of spectacular blow up of some big exchanges, that might speed up some of the regulation that will come. And I've mentioned a number of times sort of the GFC and the flow-on effect. There was a number of G20 global regulatory changes to the derivatives markets that came out of that. And another one was derivative trade reporting. So that came because of the GFC in large part. And so that's another thing. So in Australia, moving forward, if you want to get regulated, whether it's wholesale or retail, these are the things you have to look at. Derivative trade reporting to a trade repository. You've got to look at client money or client property requirements. They don't always apply. We've been doing heaps of work in those areas. You're going to have to look at a market maker license with ASIC, and ASIC have a relatively small team overseeing the retail market making, retail OTC derivatives complex products team or something. I think that's what they're called within the broader ASIC markets team. You're going to have to look at the new regulatory regime and how that overlaps, whether they embed it into the Corporations Act or whether they create a new piece of legislation. I think our firm's view is starting to move towards just put it in the Corps Act, because otherwise we'll just do a full circle like the NCCP Act, the Consumer Credit Act, which ended up being almost the same anyway, even though its whole intention was to be this square peg in a square hole sort of solution to consumer credit. Didn't end up that way. It's almost the same as the Corporations Act. But anyway, so we're going to see a whole lot of regulatory reform. We all know that. Yeah, that's not great in terms of cost of business, but then it makes, if it's done properly, it'll make Australia, as Lisa, you were saying, a place where everyone wants to cover that time zone. So they want to be in Australia and they want to be regulated, and it'll be considered, a sort of a good launch pad for other Asia Pac areas. And that's certainly been the case with retail derivatives in our experience over the last 10 years. A lot of global listed entities coming into Australia so they can set up their head office here and reach outside of the country as well. That's sort of in the retail OTC leverage sector, so the CFD sector that's been squashed. The market's been affected heavily by the product intervention order that came in last year, limiting leverage. And so that's something that does apply to some of these crypto derivatives that we're seeing and doesn't apply to others. So key message time. We've got 7 minutes to go. You've all got deep experience in derivatives and financial instruments and cryptos. And so I'm very interested to hear what your key messages are. Maybe, Toby, I'll get you to go last because I'd love to hear a little bit more about this stablecoin issue because it's a world first. It's fascinating. It's not quite a derivative, although some stables are sometimes derivatives. I don't think that's the case here. But anyway, Carolyn, what's your key message here when it comes to derivatives and cryptos?
I think for institutional flow, this is just the final shoe to drop. Yep. For retail flow, I would say caveat emptor.
Yep.
I know there's the well-refined do your own research, but it really is caveat emptor with these kind of products. So those would be my two messages.
Excellent. Thank you. Excellent. One of my friends that I surf with is sort of an off-the-grid, uses burner phones for no real reason type of guy. He was telling me that he's trading derivatives on DYDX and synthetics. And I was thinking, wow. And there's no product disclosure statement. There's no conduct requirements. They're all offshore partially offshore. Anyway, I agree with that completely, Carolyn. Thank you. Karti, how about you? What's your key message here?
I think don't write these things off and don't be the last to jump on the bandwagon here. Unfortunately, things like the APRA heat map haven't been conducive to the industry, where you get a notion of everyone follows everyone, particularly in the super arena where everyone's too cautious. You're going to have to make the move at some point soon, because otherwise you are going to be at the bottom end of that heat map, because people have gone into better liquid pools. Yeah, good point. Well said. Lisa, how about you?
Key point. I would say that I'll just keep harping on about it, about the regulations. But I think what happens is now is that we've created an environment, and we are still going to be able to create an environment where the traditional AFSL holders and the market operators, both domestically and internationally, can now move into this virtual asset space with a lot more confidence than they could before. And I think that's a really good thing for Australia in general on the global stage. That's my point.
Good. Thanks, Lisa. Yep. Over to you, Toby.
I agree with what everyone said. I mean, it's just going to be a natural progression. The market's going to grow, but we need to, of course, look after the sophistication of the retail clientele. Yeah. Okay. Yep. Thank you. Now, Zerocap. It's been involved with ANZ. Well, ANZ have done created a stable coin for the purpose of a fairly large or very large transaction. Can you tell us about that? What are you allowed to say? it's globally significant what's occurred, I think. Like ANZ, a domestic bank in Australia has taken thought leadership position and issued the first Australian dollar stablecoin. And what we think is actually globally the first bank to issue a stablecoin. So, yeah, first of all, proud to be Australian and innovative and great to see the domestic bank done it. They've partnered with Zerocap. We do the custody of the whole solution and put the solution together for ANZ with their digital markets team. Yeah, it's a really, I think it's a really big thing. It makes so much sense for banking. I mean, you can use the blockchain to verify your transactions without having a large middle office and back office. You reduce transaction costs of going through the FX market, and it's giving the gateway to their clientele into the digital space with the backing of a bank. So yeah, we're totally proud here at Zerocap to be involved in that process from start to finish. And yeah, once again, it's real. I think it's really, really big.
Yeah, that is big. And just for the sake of the viewers, stablecoin technology has really evolved, hasn't it? Some of the earlier stablecoins were quite complex with algorithms where they burn and mint coins to try and create their own little treasury function to mirror the US dollar or another currency. And it's quite complicated, and you had to have another token that you used to raise capital, and then you'd have a basket of equities sitting somewhere that might be there or it might not be there. And then now, I mean, ANZ, it's pretty simple, isn't it? They've just got one Aussie dollar.
Yeah, I mean, there is even Tether, which is one of the largest stablecoins in the world. There is some conjecture about what assets it's holding to hold a $1 peg to the US, right? So, you know, it's its own company and it's trying to do this. So I understand that's a problem. But if you have a bank issue a stablecoin and say, I will guarantee you $1 Aussie for every one of this stablecoin, that changes the whole dynamics of its usage. You know, the barriers to entry are going to be reduced for people to enter the digital realm, right? And people use stablecoins to enter and transact there, right? And they want it to keep their value. So, yeah, once again, it's a big step forward in the adoption curve, and especially for Australia, but also globally, I think.
Yeah, absolutely. Well done for your involvement in that. Yeah, very well done. It's a big deal. So thank you for that. Does anyone have any closing remarks before we wrap up? I don't think anyone has ever complained about a forum going too short. So if we finish with 1 minute to spare, we'll be okay. So thank you everyone for your involvement. Thank you everyone who's been watching as well. And if you have any feedback, I mean, you can see all of our names. We're all on LinkedIn and elsewhere. You can feel free to reach out. Have a good day.
Bye, thank you.